Let's talk about something that feels like a huge financial mountain for so many of us, buying your first home. Today, we're going to break down the actual numbers and the real strategies that can turn that dream into a reality, even if it feels like it's a million miles away. So let me just ask you straight up, is that giant 20% down payment number the one thing that feels like a massive brick wall standing between you and your own front door? It's the number everyone talks about, and yeah, it can feel totally impossible.
Well, here's the thing. What if I told you that wall is kind of a myth? The 20% rule, it's not the only game in town. In fact, for millions of people, it's not the rule they follow at all.
All right, so let's grab a hammer and start knocking down that wall. Our first step is tackling this huge misconception head on. We're calling this the down payment myth, and we're about to bust it wide open. Okay, so forget what your uncle told you at the last family barbecue. Let's just put all the rumors and scary numbers aside and look at the actual minimums that are required by some of the most popular loan programs out there. And trust me, these numbers might surprise you. First up, 3.5%. This is the magic number for an FHA loan, which is a mortgage insured by the Federal Housing Administration. You can think of the FHA as kind of like a government cosigner that makes lenders feel a lot better about giving a loan to someone without a huge pile of cash for a down payment. Can we go even lower? Oh yeah, 3%. That's right. Some conventional loans, the ones everyone assumes need 20%, can actually be had for as little as 3% down. This is especially true for first-time homebuyers who qualify. And now for the real showstopper, 0%. No, you're seeing that right. It is not a typo. For veterans, active duty service members, and some surviving spouses who are eligible, a VA loan can make it possible to buy a home with absolutely nothing down, 0. So we've got 3.5%, 3%, and 0%. These aren't just random numbers, right? They're basically keys to different doors, different pathways to owning a home. So now, let's walk through these paths and figure out which one might make the most sense for you. Okay, let's break this down. First, you've got conventional loans. With that 3% minimum, they tend to be a great fit for buyers with a solid credit history. The main thing to know here is something called PMI, or private mortgage insurance. Basically, if you put down less than 20%, you have to pay for this extra insurance that protects the lender. Next, FHA loans. At 3.5% down, they're fantastic for folks with lower credit scores. But they have their own version of mortgage insurance called MIP, and the rules are a little different. Sometimes you pay it for the entire life of the loan. And finally, VA loans. That 0% down is obviously for military members and veterans. The huge perk here, no monthly mortgage insurance. It's a massive benefit. So, we've talked about the money you need to save. But now we've got to talk about what the lenders are looking at, and that brings us to your credit score. This little 3-digit number is without a doubt one of the most powerful factors in this whole journey. Think of it as the rule book for getting a loan. So what even is a credit score? The simplest way to think about it is like a financial report card. It's a quick snapshot that tells lenders how you've handled borrowing money in the past. A high score basically says, hey, this person pays their bills on time, and that makes lenders way more comfortable giving you a loan with better terms. And here is exactly why that score has so much power. Just look at the difference it makes. A higher score gets you a lower interest rate, which means your monthly payment is lower. A lower score? Well, you're going to pay a higher rate. That tiny difference in the percentage might not seem like a lot, but over a 30-year mortgage, we're talking tens of thousands of dollars. It's a really big deal. Okay, we're making some real progress. You've got a handle on the down payment. You know why your credit is so important. But hold on. We need to talk about a really common pitfall. It's time to look past that big, flashy price tag on the house. This really says it all, doesn't it? That sale price you see on the listing, that's just the starting line. The real cost of owning that home, the number you actually have to budget for, includes a bunch of other key expenses.
So what are these hidden costs we're talking about? Well, first, you've got property taxes. You'll pay those every year to your local government for things like schools and roads. Then there's homeowners insurance, which you have to protect your investment. And then the big one-time hit, closing costs. This is a whole bundle of fees for everything from the appraisal to the legal paperwork. You should plan on these being about 2 to 5% of the home's price, on top of your down payment.
So after you've navigated the down payment, the loan options, your credit, and all those extra costs, you arrive here, at the final checkpoint. This is the big question so many of us are grappling with. Looking ahead, does it make more sense to keep renting or to finally buy?
And look, there is no simple one-size-fits-all answer. It's all about trade-offs. Renting gives you incredible flexibility. If you want to pick up and move for a new job, you can. Plus, if the water heater breaks, it's not your problem. But buying is how you build equity. That's your own personal wealth growing over time, and it offers a powerful sense of stability.
So at the end of the day, there's no magic formula here. The best choice is completely personal. It really just comes down to where you are with your money, what's happening with your career, and what you honestly want for your life right now.
And that kind of brings us to our final thought. As you're weighing all of this, maybe ask yourself this question. Is your version of the American dream about owning a specific place, no matter what it takes? Or is it about building a future that you can actually comfortably afford? It's something to think about.